Think you need a fat bank account or excellent credit in order to buy real estate investments? Well, think again. In this video, I'm going to talk to you about all of the many options that are available to you in order to fund some of these deals that you're looking at. And believe me, a lot of these options you may not have even heard of. So let's dive in. So there are a lot of options that investors have when it comes to utilizing leverage to buy properties. Everything from traditional types of loans all the way to the other end of the spectrum, getting into creative financing and things like that. So as we walk through this, you can kind of be thinking which financial path makes the most sense to you. Now, I talk about in one of my other videos, one of my very first rental properties that I ever bought, I ended up utilizing owner financing, which is a form of creative financing, and I paid the guy $3,000 down in order to secure the property. So literally, I paid, by the time I paid the $3,000 and I don't know, maybe like $1,500 in closing costs, I was under $5,000 to get into my very first property. Most newbies, when they're getting started out, they think you've got to have 20% down on every single deal or 25% down, but there are a lot of different options out there where you actually do not have to have that much money to put down. In some cases, you can even get into deals with no money at all out of pocket. So the very first option I'm going to talk about today is conventional loans. Now, these traditional loans are backed by Fannie Mae and Freddie Mac, and oftentimes are offered by the big banks that you think about when you think about big banks, and also some of your community credit lenders, and also some of the credit unions out there. Now, in order to utilize these types of loans, you're going to need decent credit. We're talking somewhere in the range of like 620 to 680 and above is ideal. You're also going to need to show employment as well as employment history. Generally speaking, you're going to need to put down about 20% in order to secure one of these loans, and you'll need to qualify based on your debt to income ratio. Now, these loans work really great when you're first getting started out, or if you're house hacking, which is when you buy a property, you're going to maybe live in one side like a duplex and rent the other side out, or even maybe if you're buying a property and you're going to rent out by the room, a traditional loan can be a good option for you. Now, one of the downsides to these types of loans is the underwriting. It's going to be one of the most stringent underwriting types of loans, and they limit the total number of loans that you can have. So if you're able to get past the debt to income ratio numbers and all of that, typically they're going to limit you to about 10 of these loans in your name. Now, the second option out there are special loans like FHA loans or VA loans. Now, if you're willing to actually live in the property first, you can use a VA loan or an FHA loan. Now, these types of loans are owner-occupied loans, so you can't use these to just strictly go out and buy an investment property. But as I mentioned before, house hacking is a great way that you can utilize these loans. So again, let's say you're looking at a duplex. You could use an FHA loan or a VA loan if you qualify to end up buying that duplex. You would live in one side of the duplex and then lease out the other side to a tenant. Now, an FHA loan, you're typically only have to put down about 3.5%. And they're really great, like I said, when you're buying something like a duplex or up to like a quad, like a 4-unit property. Now, VA loans are awesome. You have to be a veteran to qualify for a VA loan, of course, but if you are a veteran, you can actually get a VA loan and have 0% put down on that loan. And then you can use that loan again to buy a duplex or a quad. And obviously you want to make sure that that still cash flows, which in that case it more than likely would, and you could live in one of those units. Now, the catch with these is, as I said, you must live in the property, and you need to live in that property for a minimum of a year. So you don't want to do this, get the loan and then, live in the property for like a month and then move out. You can't do that. You don't want to do that. That's fraud. What you want to do is you want to live in that property at least a year, and then at that point you can move to another property and redo the process all over again. This is one of the best ways to start with a small amount of money down, or in the case of the VA, no money down. Now, option 3 is one of my favorites. It's a DSCR loan. DSCR stands for Debt Service Coverage Ratio. Now, one of the awesome things about this is it really doesn't even look at or matter about a W-2. It even doesn't necessarily matter all that much about your credit. So if you don't have a W-2 job, or you don't have a employment history with that W-2 job, or maybe you've got a ding on your credit, that's not going to be a big factor that hurts you. These loans are built specifically for investors. So these are not loans that you would use to own or occupy a property, but instead buy an investment property. Now, as I said before, these types of loans don't really care a lot about your job or even your income and credit so much. What they want to look at is, does this property pay for itself with a tenant? And of course, one of the nice things about this when you're getting started with rentals is that's important. You want to make sure that when you buy a property, it's going to cash flow. And so part of that underwriting that they look at is, can this debt be serviced by the income from the property, i.e. the tenant? Now, these loans typically are going to require about 20 to 25% down. Another thing about these loans is they do tend to have slightly higher interest rates than a traditional type of loan. Now, this is the type of loan most investors scale their business. They don't have to worry about a limit to how many loans that they can have. And also, one of the other things as you're scaling your business and building a portfolio of rentals, if you're using leverage, is your debt to income ratio. Your debt starts to rise. And so again, these loans, there's not as much paperwork and red tape to cut through. And so this is one of my favorite types of loans, and I would definitely encourage you, on a side note, to be talking to different community banks in your area and finding out if they offer this type of loan. This is a great loan. This is the type of loan that I personally use to build my real estate portfolio. Particularly early on, I was using a lot of these DSCR loans. I would buy the rental, I would actually buy it, renovate it, I would rehab the rental, and then I would refinance out, get my money back, and then go on to the next rental and do the same thing. This is called the BRRRR strategy. But basically, I would do that, and it was a way that I could really scale up my portfolio. All right, option 4 is what's known as hard money loans. Now, hard money loans are really designed more for flippers. This is when you're going to go in, you're going to buy the property, you're going to renovate the property, and then you're going to exit the property by selling it. It's also a great way, these loans, you can actually use them to keep them as rentals, but you would refinance out to a different type of loan. So going back to the DSCR, some of the local community banks in your area may have a DSCR loan, which will give you a remodeling or renovation budget built into the loan. I have a local bank that I work with that does that for me. But if you're having trouble finding that, you can get a hard money lender that helps you to go in to fund the property, to renovate it, and then you refinance out into another type of loan like a DSCR. If you're a flipper, this is going to be golden. You're going to use hard money a lot if you're going to be scaling your flipping business. Now, maybe in the beginning, maybe you don't, but over time, if you're doing volume, hard money loans is a great way that you can scale your business. Let's say that you find a distressed property and they're wanting all cash, and you need to close fast, you need to move fast. These hard money loans are great for that because they can close very, very quickly. Typically, these loans are going to be a short term, so anywhere from like 6 months to 12 months. Some of them go up as high as like 18 months. And one of the other drawbacks is the interest rates. The interest rates are going to be a good bit higher than anything else. But again, keep in mind, you're just using these loans in a short period of time. These loans really look closely at the after repair value. So they're going to assess the property and see what kind of after repair value this property has. And that's going to be the big factor that they look at when they're underwriting your loan. These loans are really awesome for flips, BRRRRs, and whenever you need an offer that you can make that's cash or cash-like, you can utilize these loans. These lenders really care about the deal. They're not really interested in your debt to income or anything like that. They're really looking at the deal itself. A lot of these loans, you may only have to bring anywhere from 10% to 20% down payment when you're using a hard money loan. So again, if you're only bringing 10%, let's say, or even 15%, it helps you as far as not having to have so much money coming to the table as a down payment. One of the things about these loans is you just want to remember, hard money is a tool. This is not a form of long-term financing. This is a short-term type of tool that you use to help you scale and helps you when you're buying a property, like I said, to flip, or knowing that you're going to keep it as a rental, but you're going to cash out, refinance into another long-term loan. So you may be asking yourself, well, how do I find these? Well, if you want to steal my preferred hard money lender that I work with, be sure to check out the description. I'm going to put a link in there below where you can reach out and I can hook you up with my preferred hard money lender. Also, while you're in that description, check out the link to my private community. In this community, I mentor rising real estate investor rock stars. I help them with a lot of different things. It's a wonderful community. It's interactive. People are talking and communicating with each other. We provide a lot of value and a lot of assistance and mentorship in that community. So I'll have that link in the description as well. All right, moving on to one of my absolute favorites that I absolutely love and I use a ton, and that is private money. What exactly do I mean by private money? So this is when you borrow money from another investor, a friend, a family member, whatever the case may be, and you have the specific terms that you agree to in order to borrow that money. Now, the cool thing about this is terms are absolutely and 100% negotiable. So you can structure it any way you can that person agrees to. So you can structure it to where, for example, there's no origination or upfront fees that you have to pay. Most of the time, private money, there's no fees or origination stuff up front. So you save a lot of money in the sense that you're not having to pay all of that junk whenever you're setting up the loan. There's also no credit check. There's no debt to income check or anything like that. Again, the terms are able to be completely set up between the two of you. Whatever you agree to is how you can structure it. One of the things that I love about this is, for my private money lenders that work with me, is I'm able to win and be successful, but I can structure it in a way that they get really, really good returns, double-digit returns. It's a safe investment because we use a promissory note and we use a mortgage, and that way they're protected, and the promissory spells out everything and the mortgage protects them. And so you can really structure these as a win-win, and I love working with people that way they can win when I win. One of the key things about private money lending and setting all that up is you just have to really understand how to properly explain that to people and understand exactly all of the tools that you need to set up in order to protect them. Like I said, a promissory note, mortgage in South Carolina, that's what we typically do. All right, option 6, seller financing. So seller financing is a form of creative financing. And as I mentioned earlier in the video, this is what I used when I bought my first rental property. I structured seller financing, and it was funny. I talk about it in another video, so I won't get too much into it on this one, but basically I was able to negotiate with this person, the seller, to allow me to only pay $3,000 down. Now, this property was a total beater. It was really, really bad. It was beat up and just terrible. And I ended up going way over budget, as I talk about in the other video on this one. But needless to say, I was able to get into that property after closing costs and everything for under $5,000 out of pocket to get into it. So it was a really cool deal. And one of the nice things about creative financing, in particular owner financing, is that you're able to negotiate, just kind of like with private money. You can kind of set up the terms however you want to set them up. And we just had, it was actually yesterday, my acquisitions manager was on the phone with a prospect, and we're potentially going to do an owner financing structure with them as well. They wanted to get a little bit more money than our cash offer, and so we're negotiating now with them about giving them more money, but having them owner finance it for us. So again, we can avoid banks and lending and origination fees and all of that stuff. One thing I will say real fast is, because this is kind of confusing to people, the term owner financing and seller financing is the same thing. So it's used interchangeably. A lot of times when I talk about providing financing to someone, when I'm selling a property and I'm holding the note, I will say I'm owner financing that property. But then again, a lot of times when we talk about like buying it from someone else, it's their seller financing. So, but that term is used interchangeably, so don't let that confuse you. So again, one of the cool things about this is there's no banks involved, there's no credit checks. Terms are absolutely and completely negotiable between the two parties. This is a great option with landlords or older parties who are looking to try to get that kind of cash flow, or maybe they're looking to avoid a big taxable event. And this can really help you get in the game with very little to no money out of pocket. I have structured deals before where I absolutely paid $0 to acquire the property. So in some instances, you actually can buy a property with owner financing and not pay any money out of pocket. Option 7 is partnerships. Partnerships are often overlooked when people are getting started out because they think, I got to do all of this myself and I have to figure this out on my own. One of the things that I love about our community is the fact that we have a lot of like-minded people in there together. And when you build these relationships, sometimes you may be able to tackle a deal with a partner, and you can help each other, kind of where one person maybe has a struggle, another person can come in and help. And so, for example, if you have someone that's like, hey, I'm interested, I earn a high W-2, like I'm an attorney or a doctor or whatever, like I make a lot of money, but I don't have the time to flip properties. I have no time to do that. And you have all the time in the world, maybe, or maybe you have a job, but you know it's a flexible type of job, and you have the time to do it. Then oftentimes what you can do is partner up with somebody, and maybe they fund it and you do the active part of it. And you just want to make sure with these partnerships, it's very, very important that they're structured properly. I would encourage you to have an attorney like draw up the agreement so everyone that's involved knows exactly what they're doing. Because the number one thing that comes up a lot of time with partnerships is, you know, if accountability and things aren't assigned, like this person does this and this person does that, then basically nobody's doing anything, because, well, I thought you were going to do it. Well, no, you said I was going to do it. And so it gets really confusing there. But partnerships can be a really great way to finance deals. Oftentimes, someone that's a veteran investor that's been doing this a while, you may have a deal and you just need help to get it across the finish line, and you decide, hey, like, we'll do a split. I've got this great deal. If you'll kind of help me through the process, I'll give you a portion of the deal if you can fund, let's say, the purchase, or if you can fund the renovation or that sort of thing. So using partnerships is a great way to help grow your business. I know investors that's the way that they do everything, is they use partners. So just again, be aware and make sure you structure it properly where it's a win-win for everybody. So I've given you a lot of different options here. Now the question is, how do you know which of these options is best for you? So you can ask yourself, well, do I have a good solid W-2? Maybe a conventional loan or even an FHA is a good option. You might want to ask yourself, hey, am I a veteran? Am I willing to live in the property and house hack the property? Maybe a VA is a good option for you. Am I a self-employed person and trying to build a rental portfolio? Maybe a DSCR is a good option for you. Am I really looking at flipping properties and that's my primary objective? Maybe hard money is a good option. Am I absolutely broke as a joke? Maybe private money or partnerships is a great option for you if you're willing to go out and hustle and put in the sweat equity and the hard work. Am I really confident and good at negotiating? Maybe seller financing is a good option for you. So to really answer that question, the absolute best strategy is the strategy that fits your needs the best based on your current circumstances. So it's hard for me to tell anyone you should do this or you should do that, because really everybody's different, and it really just depends on what's going on in your life and in your financial situation and your amount of time you have to really determine which is going to suit you best. And the last thing I'll say about that is you don't necessarily need every option. You don't have to try to do all of these, but it's definitely a good idea to have a good understanding of your different options that you have. At the end of the day, I didn't start out with anything crazy. Like I said, I started out with owner financing. It worked well for me. And then my very next deal that I did, I used a DSCR loan, and I built relationships and I built networks, and I got into hard money and I got into private money. And so it is a process over time, and you just have to work on taking action. I talk about in all my videos, it's so important, y'all. Take action, go out there, get after it. Don't just sit back and do nothing but get educated. Take action, build relationships. I'm a big proponent of building relationships in your community with local community banks or local credit unions. That is a really great way to get access to some really good DSCR loans. Real estate investing is a game of strategy and of relationships. So be sure that you're keeping that at the forefront of your mind when you're starting your real estate investing journey. Be sure, if you haven't already, to subscribe to this channel and click on the notifications. We're putting out content on a weekly basis, and we're going to have so much information that we continue to provide on this channel that'll really help you, and it's all free. You've got all this information at your fingertips. It's very helpful, so be sure to do that. And if you're looking for something a little more, check out our community. It's a private community. Again, I mentioned it earlier in the video, where you can really get into a community of people, like-minded people. You can get mentorship in there. You can learn a lot of things for people who are in your same boat that are actually growing and learning, as well as some people who are maybe a step or two ahead of you. That's always good to learn from those types of folks. So be sure, I'll put the description in the comments below to our community, Real Estate Investors Starting Strong. As always, thank you so much for watching this video, and have a great rest of your day, y'all. Bye.